Now, I want to give you this introduction to market structure because it's going to be so useful in the further videos of this course or series, whatever you want to call it. So getting, understanding the fundamentals and the foundations is very, very key in technical analysis and especially market structure. So without further ado, as you can see, I've got some annotations already drawn out, and we're going to go through market structure, what it is, and how you can use it. So market structure is basically how the market is moving. When you see the market, it moves like up, down, up, down, up, down, basically from what you can see like this. But this is all, it all ties into market structure. Now, market structure, there's two different things in market structure. We're either in an uptrend or we are in a downtrend. Uptrend is bullish conditions. A downtrend is bearish conditions. So as you can see in this one, we're clearly bullish, right? We're making a high, we're making a low, and we're making a high. So in the trading space, people will usually say higher highs and higher lows. Why? Because this high is higher than this high, right? And this low is higher than this low. So higher highs, higher lows identifies an uptrend, and the opposite in a downtrend, lower lows and lower highs. As you can see, lower lows, this low is lower than that low, and this high is lower than that high. So lower lows, lower highs, and higher lows, higher highs. It can get a bit of a mouthful sometimes, so maybe I've said it wrong, but you get what I mean, right? This is basically just showing you how the trend is formed. And you can go look at this at the chart afterwards and just look, higher highs, higher lows. When we're in an uptrend, you'll literally be able to see the high, low pattern. So that is the very basic of market structure. But now, it's not always going to look this, artistic or this simple or this basic, right? It's going to be more complicated. So now let's move on to how it might look. And just before I move on, I just want to say that I've got my free ICT concepts cheat sheet down in the description below. It's the first link. So open that and it summarizes all the ICT concepts, the main important ones that actually work. So that's a definite, don't miss out on that. It's completely free. But market structure shift. So this is how a normal diagram or a normal chart might look like. It's not going to be very generic and very simple. It's going to look kind of complicated like this, but still you can see the lower lows, the lower highs. You can still see the higher highs and higher lows. So you can still see the overall trend somewhat, right? So in this scene here, this piece of price action, as you can see, we're going down, lower lows, lower highs, bearish trend. Whereas in this, we're making higher highs and higher lows, so a bullish trend. So you can clearly tell when we're in an uptrend and when we are in a downtrend. But how do we know when the market actually shifts and when we're about to change trend? Because, the trend doesn't always go on forever. It's not just constantly going to keep going down, 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 right? There'll be a point where it switches the trend and it becomes bullish from a bearish trend. So as you can see, we're coming down, 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 but it switches right here. And why does it switch? Because there is a market structure shift, a break in market structure. So once a high gets broken through, when price goes through that high and closes above it, right? If it's a wick, we'll get onto that later, but don't take it like that. If it's a body close, if we get a close above that high point, then it's a market structure shift or a break in market structure. They mean the same thing basically. But all that is indicating is that high couldn't be held on for any longer and it's been broken through, as you can see there. This signifies a change in market direction, a change in trend. So as you can see, we had this high, we broke it, and now we've gone to an uptrend. And you can see here, another break right there, another break right there, another break, another break right there. So this is just giving confirmation that we are in an uptrend. But if we actually had to switch to a downtrend, we would have to break this low right there. We would have to break this low in order to switch from an uptrend to a downtrend. So it would have to be something like this. If this happened and we broke below it with a body close, then we could be confident that we have switched trend and now we are going to go bearish. So it could be something like this until we might break a high and then go bullish again. So that is pretty much the basics of market structure shifts and how you can tell when there is a trend and when the trend shifts to the other direction. So now let's actually move on to something very, very key, which is going to benefit you guys so much. And this is swing high and swing low. Now, in order for a market structure shift, we need to know which point gets broken. But there's so many points in the market, we need to know exactly which one needs to get broken before our bias switches or the trend switches. So the points that we need to be broken are called swing highs and swing lows. But what makes a swing high and swing low? Well, for a swing high, as you can see right there, we need this sort of triangular formation. Same thing for a swing low. What we need is a high. We need a lower high to the left and a lower high to the right of it. And I'll show you examples, so don't worry. But for a swing low, we need a higher low to the right and a higher low to the left. So it forms that, that triangle sort of shape. So now let's go with some examples on candlesticks. So as you can see, this would be an example of a swing high. Why? Because we have this high right here, we have a lower high to the left and a lower high to the right. So this becomes the swing high because we have a lower high to the left and a lower high to the right. This becomes a swing low right there. Why? Because we have a higher low to the right and a higher low to the left. So that meets the criteria of a swing low and a swing high. So when the market price breaks through one of these points, the swing low or the swing high, that is the indication that you guys need that there is a market structure shift. And that's when you can get into trades. You can identify that there's going to be a trend change, all those things. But this is what you need to see broken. Nothing else. A swing high or a swing low. Make sure you get this and note this properly. This is an example of something that wouldn't be a swing high. So as you can see, you might be thinking this is a swing high, right? But there's a lower low to the left, right? That meets one of the criteria, but there's no lower low to the right, lower high to the right. It's actually a higher high, right? So that's not a swing high. So it doesn't meet the criteria. Same thing with a swing low here. You might think this is a swing low. It meets one criteria, a higher low to the left, but does it meet the other criteria of a higher low to the right? No, because as I was saying, it meets one criteria of the higher low to the left, but it doesn't meet the higher low to the right. As you can see, this low is lower than this low. Therefore, it's not a swing low, and we can just, not look at this, eradicate it from our mind, and it's something that we don't need to focus on. So that pretty much wraps up swing high, swing low, market structure in its very basic form, and pretty much all you need to know. And also, swing low, swing points, all these things, and make sure there is a body close above it. But now, for your actionable step and your homework for today, I've actually linked a free Notion template which you guys should use. It's got everything you need to know, and it's got your very own notes section which you can use to get all your notes and screenshot them and place it into that section from this series. So your actionable step for today is to go on this TradingView website, which you should already have, and mark out your swing points. So for example, if we look here at the chart, you can clearly see this is a swing point, lower high to the right, lower high to the left. So just mark it out like this, and maybe there's a lower low right there, a swing low right there, mark that out. Then, there's a swing high right there, mark that out. This is what I want you guys to do. Mark it out, screenshot it, and paste it into that Notion template, and always refer back to it. And more you see it, just look at what happens when this price gets broken through. What happens when there's a wick breakthrough? What happens when there's a body close through it? Where does the market go? When we break a swing low, does the market go down, or does it carry on up sometimes? When we break a swing high, does the market carry on up, or does it go down sometimes? I want you to note down every single thing and paste it into that Notion template that I've made for you. And that is going to be your homework, your actionable step. And pretty much, mark out swing points, trade it through, what happens to the overall trend. Mark that out. I want at least 10 examples from you guys, and it's only going to make things easier. Because when we get into the break-in market structure and entry models, then this is going to be in your head so well that you're going to know exactly when we need to enter trades and not enter trades. So that is the episode 4 for today. Hope you got a lot of value from it. Make sure to like this video so more traders just like you can learn from this and hopefully get funded very, very soon. But I'll see you guys next week for the forecast. And apart from that, happy trading, stay safe, and catch you guys later.